Hey everyone, it's Rick, former investment banker, buy-side analyst and prop trader with 25 years in the game. Today I'm combining positioning, sentiment, and technicals to hunt for asymmetric trade setups. Welcome to Offsides Macro. Let's talk about the concept and expression, strong views, weakly held. Druckenmiller, I think, popularized that expression with traders, but there's a dude named Paul Sappho, who, if you look him up, is described as a futurist technology guy. And I understand he's the correct person to attribute that phrase to, but correct me if I'm wrong on that. Fun fact of the day. But it's such an important concept for traders. I've said this countless times that having a view and getting married to that view will eventually blow you out. You must be agnostic and flexible. I think Brent Donnelly of Spectrum Markets does really great work, and he recently did a podcast with Excess Returns last week where they touched on this topic. I recommend listening to it. I'll link it in the show notes. Now, I always troll the so-called entertainment type discussions that use the buzzwords Fed, J-Pow, GDP, recession, whatever. And the podcast got into these things, but I think Brent approaches this in a way that I think is the proper way, if you will. And what I mean by that is he looks at these things in the context of where consensus is. He uses positioning and other factors to frame short-term trades by zooming out to the big picture and then finding out what new information will move prices. And this is what matters, right? I made a smart-ass graphic a couple of decks ago because a capital allocator asked me to write up how I trade macro and how my system actually works. But instead of text, what I did is I sent him a single chart. So if you could imagine, if you haven't seen it, it's just a picture of the S&P 500, year to date, pre-Liberation Day, at the lows in April, and then a couple weeks ago. So in other words, from roughly 6,000 down to 5,000, now back up to 6,600. And the graphic has a text box at each one of those levels, and I purposely made them identical. The words were, from memory, recession coming, sticky inflation, deficits too high, what other bullshit's out there? Mag 7 valuation and concentration, tariffs, 25 or 50. But at the bottom of each one of these boxes, I pointed out where the equity positioning was, which told us to sell in early 25, told us to buy 5,400, and told us a few weeks ago to put on this long Russell short NASDAQ trade that was a good one. So in other words, the narrative really never changed. But we had some of the biggest opportunities in equities in years. This is not complicated stuff, but I think positioning is just a very underutilized tool. I'm getting continued interest on gating my work, but I think I'll stay on Substack and here on the podcast for the time being because I'm not giving away any secrets by telling you guys this. I know I'm crunching the data a little bit differently, and I'm adding delta adjusted options positioning to paint a better picture of where positioning lies, and if you want to get into the weeds on that, just reach out. But this is exactly what positioning and consensus combined tells us for these moves, whether they're short-term or not. And by the way, maybe a 2-month trade is considered short-term for you, and that's the pushback that I'm getting from some of these guys that run longer-term books, or maybe they run long-only, but I'm sure you would have wanted to know that positioning was screaming at you to get long over 1,000 S&P points ago. Before we dive into the deck, I want to make a quick observation that I know is not being made anywhere else, and it's something that I see with the trend CTAs. What I see is the very beginnings of that cohort quietly and very slowly starting to cover their net USD short position. And to be clear, they're very short USD still. They're long Euro, Pound, Swissy, Aussie, they're long Mexican peso. But several weeks back, they flipped short yen, and very recently they just flipped to short Canadian dollar. And I'll go back to the observation again about all the supposed quadrillions of investments that are supposed to be made in the US over the next X years. Those are going to require buying USD, right? And that combined with the reasonable certainty that sovereign funds are probably cleaned up on their hedges at this point could put a floor on the USD from here. I think the best expression of this trade is the obvious one, which is short euro, not just because it's the largest weight in the Dixie index, but because it's the most offsides FX on the board right now versus USD. And one quick observation on inflation. I know that I make fun of this discussion because I'm not quite sure it's even tradable ever, even if you had the CPI print in hand, unless it was like a monster outlier. But I'm on a zillion conference calls during the week because of my event-driven trading. But there are a couple of calls that I'm very religious about being on, anytime they either report earnings or they're at conferences, and that's Blackstone, Apollo, and Walmart. I think those three firms have arguably the best dashboard, so to speak, on where the economy and inflation are, because they have their hand, especially the private equity guys, in so many different industries. So I believe they have the best real-time pulse on these things. Blackstone the other day mentioned that the Fed embeds something in the high threes for shelter cost, but Blackstone told us that their internal rent data shows something closer to the low twos, implying that CPI is just way off on that factor. And I think that factor makes up like over 1/3 of the CPI number. I think it's embarrassing that our own Fed does not have some sort of agreement with that cohort so they can paint the best picture for themselves, but that's what you get from a bunch of academics. I'll stop short there and not tell you all the reasons why I think the Fed is completely irrelevant, especially now going forward, but that's a conversation for another day. You'll hear me use the term offsides quite a bit. I've written on this extensively, but consider it in the context of a sports analogy. Being offsides is not a place you want to be. Lastly, for the best experience, I highly recommend you open the deck listed in the show notes. The charts and tables that I reference will help you fully connect the dots. So let's dive into the deck and talk really big picture here. The equities overall are at the 22nd percentile, which is up a little bit from the prior week. And the NASDAQ positioning is really bouncing around quite a bit. It's pretty volatile, 96% down to 27%, now back up to 55%. But the S&Ps, the Russell, and the Dow positioning continue to support this thesis to stay long and buy any sort of shallow dips. The one caveat to that is this shot across the bow that I saw a couple times this week where multiple bank so-called strategists started taking their S&P targets back up to highs after they predictably cut them like in April or May or something like that. On the bonds, the long bond just continues to be offside short, and now twos have joined them. I mentioned the FX positioning earlier. We don't have to go over that again. Energy positioning remains the same. WTI is very offside short right now, getting shorter week over week, and heating oil remains offsides long. So I think a pair could be pretty interesting to me. Positioning in the grains just got shorter across the board, although overall the positioning I would say is sort of nowhere. And I've been talking about the softs probably for about a month and a half now. They continue to be a standout offside short. Scroll with me in the deck to the highlighted market section where I normally start off with the equities. And again, as you can see, the S&P, Russell, and the Dow are just continue to be offside short. And the NASDAQ is sort of nowhere now after bouncing around quite a bit. Twos and the long bond, as I mentioned, are offside short. The chart below that is a proprietary Dixie weighted developed market FX oscillator that I created. A lot of people look at the Dixie contract, which is quite liquid, but I don't think paints the best overall picture. So what I've done is I've just looked at the positioning and weighted them according to the Dixie index to come up with an oscillator. And you could see it's just slowly starting to creep back up near 80%. Continue scrolling and you can see that the euro and the pound are offsides long and short respectively. And then on the emerging market side, we have the Brazilian real and the Mexican peso are pretty offsides long at this point. Scroll with me and you can see four charts here. You can see the WTI oscillator on the left, and then you can see on the right side the week over week's net speculator change, which is now down net selling 11 weeks in a row. Heating oil is offsides long, and you can see the week over week change on the chart on the right. Now we'll get into the softs, and I pointed out about a month and a half ago that the group was very offside short, and I highlighted sugar, cocoa, cotton, and I also highlighted coffee. Coffee had a monster run from something like $280 up to almost $400. It closed on Friday. Positioning there is sort of nowhere at this point, but sugar, cocoa, and cotton all remain offside short. Seasonality also supports a long position in those, so I think those should be on your radar. Lastly, if you get into some of the more obscure commodities, lean hogs continues to be offsides long, like on a bacon, lettuce, and tomato sandwich. Next section, zeros and ones, is just my dashboard for the week. If you want to click on zeros and ones, you can see a primer that I did on that, but net, what this really is showing you is the September 9 column is the percentile for each instrument based on my look back period. OPI OPI is what is in my offsides positioning index. 1 versus -1 is obviously a long versus a short. You can see where the SocGen trend indicator positions are. You can see that they're very long equities, long bonds across the board. I mentioned a little bit of a flip, a little bit of the change in the FX at this time. The long gold and silver, long energy with the exception of natural gas, and then they're mixed in the grains and the soft. If you scroll a little bit lower, I added something different this week. I'm trying to make this a better dashboard for myself. So what I did was I added the inflation swap, week over week changes, I added credit spreads, and then I added the vols of the VIX, VVIX move, and the FX volatility week over week. Last section is the OPI, my offsides positioning index that I've written on about extensively. If you click on the OPI, you can go to a primer that I wrote on that. But net, this is just a blind index that I created just as an experiment to see if blind positioning actually works or not. And you can see that the performance has been really good year to date. I use this as my North Star for my discretionary system so I can see how things are behaving with positioning. And the OPI implied exposure box at the top of that I think is pretty interesting. I'll try to explain it very quickly here. Each instrument across all asset classes has some sort of implied correlation to S&Ps, to bonds, to the dollar, and to commodities in general. So what this does is basically weight each of the asset classes across the board to tell me what the implied exposure is for these 4 categories: risk on, off, TENS, USD, and BCOM. And I don't have a large enough data set to tell me that if this is a useful tool or not, but I know that it was very helpful in the last 18 months trading currencies, and I know that it was screaming at us to get long S&Ps in the low 5,000s across the board. So stay tuned on that. I'll continue to track that for us. Thank you for coming to Offsides Macro. The views expressed are my own and do not represent the views of any employer or affiliated institution. Nothing discussed should be considered financial advice. This content is for informational, educational, and entertainment purposes only.